This is the Asia Trade. I'm Shery in Tokyo.
I'm Avril in Singapore. The top stories this hour. Hong Kong firefighters close to completing their search of burnt-out apartment towers after the city's worst fire disaster in decades claims at least 94 lives. A cautious open ahead for Asian markets with the U.S. closed for Thanksgiving. Bitcoin trading above $91,000 in a sign of returning risk appetite. And on today's edition of Bloomberg Tech Asia, we take a deep dive into the risks around the circular deals driving the AI boom, including SoftBank's multi-billion-dollar exposure.
Let's start with our top story. Hong Kong firefighters close to completing their search of 7 burnt-out apartment towers after fires now known to have killed at least 94 people. Dozens of survivors remain in hospital, with hundreds more left homeless as a criminal investigation continues into the cause of the disaster. Our China correspondent Min Lo joins us now from an evacuation center in Hong Kong, and of course hundreds have been displaced. Min.
That's right. It's a chilly morning here, and we are actually near a neighborhood estate that is just across from the scene of the fire. And you can still see there are a couple of apartment units that seems to still be burning. We're seeing smoke billowing out as well. And that is despite the fire department saying that they would have everything under control overnight. They did say that once the fire subsides, they would be making forceful entry into every single unit to just look for anybody that's still trapped. And that's supposed to be complete by 9 a.m., so a couple of hours from now. And we are at this evacuation center. I passed by the area and there was lots of boxes of donations, and in fact I saw a sign that says they are rejecting any further donations, so it seems like they already have sufficient items that they need, and people are just sleeping in different places. There are 9 of these evacuation centers or shelters that the government say they will keep open until the residents no longer need them. But the longer term plan, the government said they have identified about 1,800 units across Hong Kong that could serve as transitional housing in the longer term, and some hotels are also participating to provide temporary housing for now as well. The chief executive John Lee did visit the site of the fire yesterday, and he announced about 10,000 Hong Kong dollars for each affected family, but that's just about $1,300 and really quite meager if you consider that the living cost in Hong Kong is extremely high. He talked about concessions for public transport fares, but these are really minor things to cheer about given the enormity of the losses here.
Min, it's heartening to see this outpouring of support, as you say, at these evacuation centers. But talk to us about, have we learned anything further about how the blaze got so bad?
Yes, and this is a thing I think many residents would feel quite frustrated about, because at the press conference yesterday, there was focus on the financial help given, but not enough reflection on the cause of the fire. And yes, John Lee was pledging to completely phase out bamboo scaffolding in Hong Kong, which would be a step up from the previous move to just require about 50% of public works to replace bamboo scaffolding with metal ones. But still, some residents are saying this is perhaps diverting the issue from the crux of the matter, which is the inspections, the enforcement, who should be accountable for them, because the Labour Department said they did inspect the site of the renovation as recently as last week, and they did find the substandard materials there, and yet why wasn't any change being made ahead of the fire? So who should be responsible for that? And a task force has been started to just look into a corruption investigation. So it seems like they are suspecting some sort of irregularity in the contracting process or in oversight. So that's something to keep an eye out for. But yes, residents are still demanding answers, because many people online are saying that it's not the bamboo scaffolding that is the matter, because there are the green mesh that are covering the scaffolding, the styrofoam boards sealing the windows, the plastic tarpaulin. These are things that shouldn't be present at the site at all, and it's the non-compliant materials that are at fault, because Hong Kong has been using this bamboo scaffolding for over a century, and some people are really proud of this intangible heritage.
Yeah, Min, to your point, it's really about the enforcement of the existing regulation that's come under scrutiny at the moment. Min, thank you for your reporting. Bloomberg's China correspondent Min Lo. Now, still to come on the program, we talk market strategy with Motley Asset Management and UBS Global Wealth Management. And in today's episode of Bloomberg Tech Asia, Asymmetric Advisors weighs in on the risks of circular deals in the AI sector. Much more ahead. This is Bloomberg.
It's going to be a thin trading session around the world given that the U.S. is away on Thanksgiving holidays. And you can see Nikkei futures not doing much at the moment, but after they outperformed in the previous session, the yen continuing to hover around that 156 level per dollar. And we're also seeing the ASX 200 down 0.3% in early trading. The South Korea market also outperformed. We just got the industrial output numbers falling more than economists had expected. What's interesting is that the year-on-year number fell 8.1%. That was pretty much expected because of the timing of the Chuseok holidays. But month on month, we also saw a decline of 4%. So that very strong semiconductor export surge, especially for the month of September, when we saw gains of 25% for those shipments, didn't necessarily help in keeping this industrial production number in the positive, Avril.
Yeah, Shery, you talked about how we are seeing thin liquidity and light trading because of the U.S. being shut. But at least, I guess, investors can take heart that the all-country index is on its 4-day winning streak. So maybe we end November in a positive note. And against that backdrop, we are seeing, of course, global stocks holding firm to those gains. Worth noting that when it comes to Europe, with, of course, a bit of direct from the economy there, or rather from the ECB giving us that via its minutes, we did get some indication that perhaps we are seeing a central bank that is open to rate cutting while it can, versus previous expectations that maybe some of these central banks, say for the Fed, were done with cutting, right? And then you look at how the direction in the euro or the euro stocks, FTSE, everything else look pretty flat. We are, of course, still keeping in mind how the Fed is likely to cut interest rates faster than previously thought. That's at least what the markets are expecting. And this is coming amid pressure on U.S. corporates. We have U.S. department store chain Bloomingdale's cautiously optimistic, though, about consumer spending despite inflation and tariff pressures. CEO Oliver Braun shared more about their big plans for the holiday season.
I think it's really about coming back to the origins. What we want to build right now with the team is actually rebuilding the next golden age of Bloomingdale's. We heard a lot about Bloomingdale's in the 70s, in the 80s, when it was really the place to go. And actually, right now what we're trying to build is really recreating this destination, Bloomingdale's. And we're an icon, but we have to reinvent ourselves. It's also what Josh is doing with Burberry. This is what we're aiming to do at Bloomingdale's, with one key focus is actually enhancing, bringing back customer experience, customer delight in our stores, and really based on building relationship connections, etc. This is what is making us different.
I want to talk about this particular holiday season. I mean, times are a little bit challenging economically, and there's been a lot of talk about how much capacity the consumer has to spend. Are you feeling optimistic about what people will spend on this year?
I'm actually cautiously optimistic. The trend over the past few months has been amazing at Bloomingdale's, so we feel pretty strong. We feel pretty strong about our customers' feedbacks, about our partner feedback, about the current trend that we're experiencing, and we're building such a great event for this holiday season that we're convinced that it will resonate very, very well with the customer. The customer now, 3 years ago, was all about luxury, high luxury, etc. We can feel that customer behavior changes a little bit, a bit more to high-low, to contemporary, to luxury. And you know what? This is exactly what Bloomingdale's is about. So we feel very, very strong about this holiday.
Bloomingdale CEO Oliver Braun speaking with Bloomberg's Romain Bostic. Joining us now is Bill Mann, Chief Investment Strategist at Motley Asset Management. Bill, great to have you with us, and thank you so much for joining us during the Thanksgiving holidays. How much is there in the markets to celebrate right now?
So here in the U.S., we had a fairly tough beginning of November and up until last week, and it seems to have reversed itself. I think one of the things that we're seeing in the markets here is a fragility, and really the U.S. markets right now are being driven by three things. They're being driven by affluent consumer spending and AI investment, and then asset appreciation. And so those are the three legs of the stool. And so I think people here in the U.S. and investors are a little worried that that the drivers of the U.S. economy are a little bit thinner than they have traditionally been.
Bill, are we expecting the U.S. consumer to keep spending during the holiday season, even if we don't see rate cuts that have been widely expected from the Federal Reserve?
Yeah, I think so. And I do think that the Fed rate cuts are coming because I think that they are also fully aware of the importance of affluent consumer spending in the country right now. And you can see it in the markets as well. There's a real division between the Magnificent Seven and then also, the companies that have no revenues or no profits have done very well. But the companies in the middle have been left behind. And so that's where the real economy is here in the United States, and we're feeling it. We see, we see in a very soft way, people are having difficulty finding jobs in a lot of markets, and so I think that they are attuned to the fact that the true economy here in the U.S. is somewhat brittle at the moment.
Bill, everything you've been alluding to seem to point to a sort of two-speed economy, K-shaped one, whatever you want to call it.
Yeah.
How much of this becomes a problem down the road in 2026?
Well, if you think about what the U.S. markets look like, take the S&P 500, and we have the largest concentration in any one industry that we've had in our history, and we've got companies like NVIDIA at $5 trillion that are 9% of the market cap of the S&P 500, which is, it's fantastic. It's a wonderful American company. The way that you solve that is really one of two ways. It's getting the other 493 to increase their market caps, or it's for companies like NVIDIA and Alphabet and Apple to decline somewhat precipitously. And so we've never really been in this position before where you have one industry that has that much, dominates the market to the degree that it does. Motley Fool Asset Management, we have backed these winners in the past and we continue to do so. They're absolutely wonderful businesses, but there is a remainder of the economy here that, that really does, could use a leg up, and, the expected rate cuts, I think, will help.
But as we know, monetary policy can be quite a blunt tool, especially when it comes to issues such as inequality. I mean, weaving that together, the economy and the markets, to what extent do you think that's going to be a problem?
Yeah, I love the way that you frame that. That's exactly right. They really do only have blunt instruments, and it takes months once you do cut rates for it truly to get into the economy, because essentially you are withdrawing or adding dollars from into the economy, and it takes a little bit of time. I think that they are they are really doing a fairly difficult dance, because you look at the AI investment environment, and people do wonder if it's a bubble. We have seen this type of infrastructure investment before, and it hasn't really paid off for the infrastructure before. AI, I think, is a different beast. I think that there are enough jobs in this country that are pointed to industries that are outside of that segment, that's what they're actually going to pay most attention to, and let the AI investment path take care of itself.
Bill, so when it comes to letting that take care of itself, when you're investing in the markets, do you stay put, or are you taking some profits now, because we're essentially seeing some peak tech bubble talk at the moment?
Yeah, I think that if you are very heavily levered towards tech, and again, it's hard to be over levered towards tech since it's it's nearly 40% of the S&P 500 is the technology the technology industry. There's some wonderful companies and wonderful industries here in the U.S. That have not gotten that same level of attention paid to them by the market, and so rather than say take profits away from what has worked. I tend to assume that it's going to continue to work. What I would suggest is that there are other parts of the market that are somewhat undervalued, and in an accommodative environment, such as the banking sector and the energy sector, should do pretty well.
Would you go overseas as well?
Yes, I mean we do have exposure outside of the U.S. In one of our ETFs. There are obviously we've been very accommodative about the Japanese market and Japanese stocks. That's gotten a little bit difficult to over the last month, but I still do think the fact that you're seeing a liberalization in that market has helped a great deal. We are interested in the Indian economy. It's very difficult for Americans to invest in India, but it is another place where we see a lot of potential.
Not necessarily the Indian market, but for example, in Northeast Asian economies, we have seen the upside when it comes to semiconductors, anything tech related that could really help with the AI infrastructure build out. Have you looked at these sectors?
Of course, yes. We've paid a very, very close attention to this segment outside of the United States. The reality for us in the U.S. is that you can get a tremendous amount of exposure only holding U.S. companies, and so bets away from the United States, even within the sector, can become somewhat problematic for your asset allocation. But there are absolutely fantastic companies in Northeast Asia that are in this space and will absolutely be very, very important for the growth of AI.
When you look at Asia, though, I mean, you mentioned Japan, you mentioned India. On top of AI, what else are you kind of positive on in these markets? I mean, is there another lens that you're looking at it as perhaps a sort of diversifier to the U.S.?
Yeah, we are very much interested in some of the consumer brands within certain Asian markets. Coupang, for example, is a company that we've owned for a very long time, and look forward to continuing to own it for a very long time. There is the Asian consumer is it has a somewhat different manifestation than American consumers do, and it is it's an area that we have a great interest in, if for nothing else because it is wonderfully diversifying for American investors.
What about China, Bill?
Yeah, so China is a market that has really been hit pretty very hard, and some of the Chinese companies that we have had long associations with, like Alibaba, are once again incredibly interesting. They finally have gotten a bit of a bid after a period of time in which they had not done very well. But as far as we are concerned, we tend to only focus on the largest of the Chinese companies.
Bill Mann, Chief Investment Strategist at Motley Asset Management. Really great to have you with us. Thank you so much. We'll actually be talking a little bit more about Alibaba in the next hour. We'll also be exploring the circular deal shaping the AI world and how Asian firms are seizing opportunities or facing new risks. That's coming up on Bloomberg Tech Asia. More ahead. This is Bloomberg. Russian President Vladimir Putin says no final version of a plan to end the war in Ukraine currently exists. He says President Trump's 28-point proposal could serve as the basis for a future deal and has signaled openness to peace talks. Let's bring in Bloomberg editor Michael Heath. And Mike, we continue to talk almost in circles right now. Has anything fundamentally changed, and what are the minute developments that we're seeing?
Hi, Shery. Yes, I mean, look, it's hard to say that a lot has changed, but I mean, President Trump is clearly trying to force the pace, and that's what this 28-point proposal was about that Vladimir Putin is referring to there. He was speaking at a press conference in Kyrgyzstan, but the thing is that Europe and Ukraine has sort of since had that amended somewhat, and so it's just very difficult to know which plan people are talking about. Clearly, Putin is talking about the original one there, which wasn't acceptable in total to Ukraine and Europe. So you know we've sort of gone past what he's talking about. Nonetheless, he's obviously trying to keep communications open with the US and keep a good relationship there. And the White House certainly is I don't want to say bending over backwards, but it's doing all it can to keep channels open with Russia and keep Russia on side there. Another interesting thing that President Putin said, though, was that, once Ukraine withdraws, the war can stop. I mean, it's a sort of an interesting notion because Ukraine's going to withdraw from Ukrainian territory. I mean, it's just sort of, it's slightly illogical. But the upshot seems to be that Russia is making very, very slow progress here. Ukraine is really struggling. And for Putin, he's just going to keep pushing that until he, I guess, feels that he's got as close as he can to what he wants. So we're sort of in the same status quo in a way, other than President Trump does seem to be pushing to get something happening, and his envoy Steve Witkoff is expected to go to Moscow next week.
You talk about this sense of urgency from Trump and the U.S. I wonder, what do we know about how Putin feels about this? What is his end game, given how this is also, on his part, dragged on for, 4 years?
Yeah, I mean, look, what it's really highlighted is the parlous state of Russia's armed forces. I mean, you think back 30 years ago, the Soviet Union was a superpower. Russia's the inheritor state, and its military was absolutely superb. I mean, it challenged the US all over the world, and now it's struggled to get 4 territories in its former Soviet republic in Ukraine. So yeah, look, it does show the decline of Russia, and what we're also seeing, and Bloomberg's done some good reporting on this, is this slow weakening of the Russian economy too. And while President Trump sort of really had an olive branch out to Vladimir Putin, the US did sanction a couple of big Russian oil companies, and that, I think, is affecting Russia's economy too. So there will be growing pressure on Putin economically to do something here, I think.
Mike, thank you for talking us through what's at stake here in this conflict that has dragged on for so long. Bloomberg editor Michael Heath for us. Now, on to one of the top global headlines we're following as well. The Japanese government has denied a report that President Trump advised Prime Minister Sanae Takaichi to avoid provoking China over Taiwan. The Wall Street Journal report says Trump gave Takaichi subtle advice on China during their call this week, but did not pressure her to retract her recent comments. Japan's government says it has made an inquiry to the Journal over the story. China has issued a warning to countries not to stir up trouble around Taiwan after a New Zealand Navy ship passed between the island and the mainland earlier this month. China's defense ministry says it opposes any country sending wrong signals to Taiwan. This is Bloomberg.
We have breaking news out of Japan. We are getting the Tokyo CPI core inflation excluding fresh food. Year-on-year growth of 2.8% for the month of November, accelerating from the previous month, but coming in line actually above economists' estimates, but coming in line at the same rate than the previous month. Exclude fresh food and energy, and you get core CPI, core CPI, and that's 2.8% in line with the estimates. The headline, 2.7% growth in prices across Tokyo. Very important because this is, of course, an indicator of national prices. The jobless rate coming in at 2.6% for the month of October, which is at the same rate than in the previous month, slightly higher than economists had expected. Also, when it comes to available jobs per 100 applicants, 118, and this has come down from the previous month. That's for the month of October. We have seen the labor shortage situation in Japan leading to more wage growth in the country, and we're now seeing that the job-to-applicant ratio has in fact gone down to 118. Of course, all of these numbers very consequential, Avril, when it comes to the Bank of Japan policy decision coming up next month, December 19th.
Absolutely, and it's really, will there be a rate hike? I mean, you think about how pockets of the market still think there's a possibility, but does this number that we're seeing actually give the Prime Minister a bit more space to urge patience on rate hikes, given how it's not a terribly sharp price gain, even though it is coming in a bit hotter than the estimate if you're excluding the fresh food factor? Now, take a look at how the yen is faring against the greenback. It's moving towards the 156 level. You have the dollar still looking pretty soft. This has been the case all of this week. And when it comes to some of the antipodean currencies, take a look at how the Kiwi dollar is faring. Of course, we have been seeing this as one of the weakest G10 so far this year, if not the weakest. But the RBNZ this week, in signaling that maybe they're done with easing, actually meant that we saw that bit of a climb, although we are seeing Aussie versus Kiwi dollar. Actually, they're not that far from those multi-year highs for the moment. Now, in terms of developed market currencies, we're also watching the Korean won after its decision yesterday. What was interesting was also how the Governor Ri Chan-yong talked about how the NPS maybe needs to signal to the markets in a different way when it comes to FX intervention. But we are seeing the Korean won gaining ground. For more on the path ahead for Asia's central banks, let's bring in Louise Loo, lead economist at Oxford Economics. Louise, really good to see you. Thanks for coming in today, bright and early. So we've just been unpacking what we're seeing in Japan, and the numbers look like it could go either way, right? It could feed in the case for the BOJ to hike, but then it's maybe not fast enough. So what is your sense of how this plays out in December, and when will we finally see all the stars align for the BOJ to pull the trigger?
Well, our view, which may or may not be the current consensus, is that we think the BOJ would actually go ahead and pull the trigger next month and actually hike rates. And we think part of that consideration is really how the Japanese yen is doing. Not so much the inflation side, which has always been creeping up. And we know for a fact that given the fiscal, I would say, Davism of Prime Minister Takaichi, that number is probably going to come up even more in the coming quarters. So we think that the BOJ would likely, want to act to preempt that and maybe raise rates. And we're talking about not tightening. We're talking about a normalization of what is ultra loose policies for a very long time. So that little bit of tightening we think could, keep that yen weakening in check, and perhaps, give a bit of room for fiscal policy to kind of feed through to the economy.
If that's the case, they will have to start preparing the markets for that around now, right? Because how much time do we have until that BOJ meeting? Yeah. So when do you actually see the BOJ starting to telegraph this?
Well, I think the market is quite split as to whether or not BOJ might hike. The risk is obviously to skew towards not hiking, but to the extent that we think that BOJ might start to hike, I think in the coming weeks we could see a slight telegraph towards that. Obviously, Japanese markets are very sensitive to what the governor is saying. I think today's inflation print doesn't really give much of a I would say, pivotal view on whether or not BOJ might move. But looking at how the currency is, looking at Prime Minister Takaichi's dovish pivot on policies, I think, is probably right for them to start normalizing their policy.
No, I was going to say, because the inflation picture has already been there for quite some time, above the BOJ's 2% target, right, for years. And yet the BOJ hasn't moved. And a lot of it has been said to be because of the political change. We have gone through that political change. We have a new prime minister. And the yen trading on the 156 is really not giving the BOJ much leeway. If they hike, will that help support the currency?
It could. I think conversely, the point here might be that if they don't hike, that will probably exacerbate downward pressures on the currency, especially given the fact that the Fed might actually start pulling down rates again in December. Again, that's another big if. Then they might want to kind of, leverage on that differential by going the other way in December.
How much are central banks across Asia keeping an eye on what the Federal Reserve will do? Because we have seen that switch in narrative recently with more dovish Fed speak.
Yeah, well, central banks in Asia, I would say they're doing their own thing, especially across advanced Asia, where for a lot of these central banks, rates are already near neutral, or at least they are already at very accommodative levels. So I think there's a lot of attention that's given on the currency side in recent weeks. You look at the the Bank of Korea's decision yesterday. You look at RBNZ's decision earlier this week as well. These advanced APEC central banks are probably done in their current easing cycle, despite the fact that the Fed probably has probably another 100 bips more to go. So I think currency is at the forefront of their decision, and by and large, that cycle, the monetary cycle in Asia is becoming more and more decoupled from what the Fed is doing.
What's also been decoupled or divergent is the growth track, right?
Yes,
we've seen how
absolutely.
AI has been a driver for long enough that there are these implications playing out. So you have one fast track when it comes to chips, when it comes to tech. I wonder, though, is this something that monetary policy can fix? Is this a problem for governments, and how might they think about addressing it?
Yeah, no, that's an excellent point. I think when we think about the incoming growth impulse from AI, much of that is kind of feeding to very select segments of the economy, and that's not really something monetary easing can support. It's a very blunt tool when it comes to that, which is why I think going forward, especially for economies across advanced Asia, Korea, Taiwan, Australia, and New Zealand to a smaller extent, these are economies we think would actually resort to maybe fiscal support to support the economy rather than monetary rate cuts. So I think that transmission of monetary rate cuts in an environment where economies are becoming more and more K-shaped is probably not that effective.
In the scenario where governments actually start thinking more seriously about how to support the slower parts of the economy that are not benefiting from AI, what do you think they can do?
Well, yes. So that's a big question. I think there are different ways. Across advanced Asia, we could think of more targeted household subsidies, wage subsidies. Across developing Asia, they are likely to kind of go into more of the investments or public investment drives, infrastructure spending. So there are different avenues by which they can enact that. But obviously, the kind of measures that would have a more immediate impact on the economy would be the ones that directly put money into households' pockets.
Louise, great to chat. Thank you so much again for coming in bright and early, talking us through this roundup of central bank action and their path ahead. Louise Loo is lead economist at Oxford Economics. Now, we have some breaking news crossing the terminal for you. We've since are hearing that one National Guard member has died from this DC shooting. Of course, this is a shooting that we saw earlier in the week, and 2 National Guard members had been in critical condition following this incident, and Trump has said that he was just informed about the death. Of course, he was giving some of these virtual remarks to troops amid the Thanksgiving holiday, and he has also called the DC shooting a terrorist attack. Again, he was addressing U.S. service members amid the holiday, and we've also been hearing how the suspect had been identified previously, and that has also prompted some commentary from the U.S. president in relation to immigration. We have more ahead on the Asia trade. This is Bloomberg.
There's been a lot of talk about an AI bubble. From our vantage point, we see something very different.
What's different in this cycle is the problem we have right now is supply, not demand.
What you see with the level of spending that they're putting into it. So it's a lot and it's moving fast. But the difference between now and 2000 is that these are massive companies with strong financial performance.
A lot of the bubble could be potentially in terms of the run-up on the valuation side. But the fundamentals of the industry, I think, is a long-term trend.
My stance generally is that bubbles are a good thing because they mobilize capital and talent into important problems, important sectors. And I think we are in a really interesting time.
Many companies about a year ago were waiting to see what was going to happen with the AI bubble, but now no company will have the stomach today to wait for what might happen. The question that companies are asking themselves today is, are they moving fast enough?
I think, over to say 10 or 100 years, I think we'll gradually underestimate the technology that is AI.
Tech and global executive speaking to Bloomberg about whether the AI boom can endure. Staying on AI, and Alibaba has made a rare foray into hardware, releasing smart glasses powered by its Qwen AI models. The product, called Quark S1, features built-in translucent displays that superimpose contextual information on the user's view of their surroundings. The glasses are equipped with cameras, bone conduction microphones, also swappable batteries. They're available now in China, with Alibaba promising international versions next year, Avril.
Shery, as we talk about the latest rollout of Alibaba's product, I think it's also worth keeping track. I mean, amid their earnings, something that our Bloomberg Opinion columnists have highlighted is that it also shows you this embodiment of the Chinese economy in a way, right? This is one of the biggest Chinese companies. So it shows you when it comes to AI and how those bets have been playing off. Cloud revenue looks great, but what about the other segments? Look at e-commerce. So to some of our analysts, opinion columnists, this really speaks to this two-speed economy. There's one part that is strong. There is another that is looking pretty shaky. So it's really interesting in terms of this two-speed economy that we're seeing, Shery.
Yeah, because you saw in the results Alibaba's cloud division, for example, growing at a better than expected 34% compared to the year before. And of course, this division is home to the very popular Qwen AI model, and it was downloaded more than 10 million times since its relaunch last week. And what you're talking about is a fragility when it comes to e-commerce because of the price wars, right? So you have this two-track economy. But what's also interesting in this sector is when you see all of these Chinese companies compete in the AI sector, not everybody is spending as much as, for example, their U.S. counterparts. The U.S. firms have access to chips from NVIDIA, so you are seeing China, for example, taking a more low-profile approach, low-cost AI strategy, smaller, efficient AI models, and perhaps Meituan is also one of them. They're integrating it into their products instead of spending an enormous amount just on AI infrastructure build-out. They're expected to post their first operating loss in about 3 years, though, reflecting the toll of competing with Alibaba and JD.com. The stock, already the worst performer on the Hang Seng Tech Index this year, and consensus estimates have been dropping for months. For more, Bloomberg Intelligence senior analyst Catherine Lim joins us now with the latest. And Catherine, as we were talking to Alibaba's pressure because of this price war domestically, is that what we're going to see with Meituan as well? And what will you be watching?
Right. Meituan has definitely already guided that, for the September quarter that it is reporting later this afternoon itself, they will be sinking into losses. I guess the question is the magnitude of which, and more importantly, as you've actually highlighted right now, we've actually seen Alibaba guiding that, they think their investments into this business itself has peaked. And it does seem to appear that competition, which is what has brought everyone's profit down, Meituan's into losses itself, we might actually be seeing things improving sequentially. Again, the question is, are we going to be looking at narrower losses? What is the real margins for this business in China going forward, given that, the whole backdrop to consumption isn't still all that robust?
Given that backdrop, what do you think we will find out a bit more on its overseas plans, particularly in the Middle East? What will its priorities then be?
Yeah, that's definitely still going to be a growth engine that Meituan will be building in the Middle East and, into Brazil itself. Now, that's going to actually take them investments, and that is where the new initiatives will actually continue to be in losses. Well, given the record that they have actually built for Kita in Hong Kong, we do see some, positive light that they may be able to actually make inroads. But then again, Hong Kong is Greater China. We're now looking at a completely different operating landscape of Middle East and Brazil, whereby there are global competitors out there. So that will still remain a question mark. We'll have to see how aggressive Meituan is in 2026, how they guide for it in particular this afternoon when they report.
Kat, thanks so much. Our Bloomberg Intelligence Senior Analyst, Catherine Lim. Now, continuing that conversation on tech in the next hour, where we explore the circular deals shaping the AI world and how Asian firms are seizing opportunities or facing new risks. That's coming up on Bloomberg Tech Asia. This is Bloomberg.
And we have more breaking news out of Japan. We are getting the industrial production numbers. Output rising 1.4%. The estimate was for a contraction and also really sustaining that momentum of gains from the previous month year on year. Month on month is a gain of 1.6%. And we are seeing for month on month a gain of 1.4%. Retail sales gains month on month 1.6%, year on year 1.7%. Suffice it to say that both numbers are surprising to the upside. For more on the state of the Japanese economy, let's bring in Bloomberg Tokyo economy and government reporter Erika Yokoyama. Erika, so we saw industrial output surprising to the upside, retail sales also surprising to the upside, Tokyo inflation numbers earlier surprising to the upside. Does this mean that the BOJ has at least the reasoning to move as soon as next month?
Well, as you just said, the core price index, excluding fresh food, was stronger than market expected. So I think it will keep the BOJ on track for the rate hike. And I think we should not rule out the possibility of the December hike as well. And looking closer into the report, private services prices are also rose over 2% from a year ago, in sign that inflation has been spreading across the variety of sectors. And that has been one of the conditions that BOJ has been seeking for the tightening action. So I think today's data basically helps tick one of the boxes for the bank. And at the same time, we've been talking about this a lot, but BOJ should be cautious about the yen trend, as there's high risk that the recent weakening yen can accelerate the inflation again. The yen hit weakest level in 10 months earlier this month, already prompted the government official to strengthen the warnings over the effects. And finance minister even hinting at the market intervention as a possible option. And also former BOJ director Monma-san told us that the December hike is very likely or possible, citing the weakening yen. yen. So considering today's data and the risk ahead regarding to the weekend, BOJ has some potential and push factors to move in December, I think.
What about how effective Takaichi's economic package might be in easing prices, even as we watch the monetary policy?
Yeah, we have to think about the combination. So Takaichi rolled out the largest economic package since pandemic, and actually her cabinet is set to approve the extra budget to finance that package later today. And according to a paper seen by a Bloomberg, 2.9 trillion yen is allocated on price relief. That includes subsidies for utility bills, regional support funds, and reduction of gasoline and income tax. And SMBC Nikko estimate that these measures together can cut core CPI by 0.38 percentage point next year at the national level, and the leading can fall below 2% in January. It's true that some economists are saying that it could accelerate the inflation, but I think at least we're going to see the sizable cut, the slowdown in CPI next few months.
Erica, just quickly, is that government support perhaps a reason that we continue to see solid retail sales, also industrial production coming in pretty strong? Are they stronger?
Yeah, actually, it's also hard to tell, especially like retail sales, because that includes some of the spending from the inbound tourists. And, you know, we have a risk that now, especially like Chinese tourists can decrease in number and also the spending amid some spat over Japan and China caused by Takaichi's remark. Also, we are seeing some slowdown sign in the labor market as well. So there are some downside risks in the economy, and we will see whether Takaichi's measure can support and shore up these areas.
Erica, I think it's so interesting you highlight the impact that tourism has had on retail sales, especially given the weakness of the Japanese currency. Good to get your insights on all this. Bloomberg, Tokyo economy and government reporter Erica Yokoyama. Of course, we've been tracking how these markets have been faring as we shape up into the session. A couple of things we'll be watching, including how we are expected to see this continued positive tone in Asia markets, although lacking in direction because U.S. markets were closed overnight. We'll track the open. This is Bloomberg.
This is Asia Trade. We're counting down to Asia's major market opens without clear direction when it comes to the Asian markets, given, of course, Avril, that the U.S. markets are away on holiday. Still plenty for investors to digest out of Japan, with most of the economic data surprising to the upside.
Yeah, it's interesting. Even though we have the data backing the case for the BOJ to hike, will we see enough messages between now and the next central bank meeting that will prepare the markets for the BOJ potential hike, Shery?
Yeah, because you don't want what happened last summer when we had that squeeze with that rate hike coming by surprise to investors. So we are going to be watching that December 19th rate decision by the Bank of Japan. But so far this morning, we got all of the numbers for industrial output, retail sales. Also, we got other data surprising to the upside in today's session. Tokyo CPI is the one that I'm missing. So basically, that is an indication of headline prices, right? So are we seeing more inflationary pressures here across Japan is a key question. You can see not a lot of movement when it comes to the Japanese market opens, and the yen still sitting at that 156 level against the greenback. Of course, we're watching the tech sector very closely as well, because that's seen a little bit of a rebound in the last few sessions. We'll be watching that in South Korea very closely, because we actually saw industrial output surprising to the downside when it comes to Korean economic numbers. Even given the fact that we actually saw exports of semiconductors surging about 25% for the month of September. So this just giving a little bit of indication that industrial output and factory data still remaining a little bit weak when it comes to the South Korean economy. The Kospi gaining 0.1% after the BOK left the rates unchanged, but then they signaled that they were still leaving the door open, Avril, for a rate cut.
Yeah, how wide is this door, though? I mean, you look at this week, right, from the central banks that we've heard from, not just the BOK, but the RBNZ as well, and markets seem to have made up their mind that a lot of them are done with this easing. You think about as well that Australia data, inflation looking pretty hot. Maybe the RBA is also done. So where does this leave the US dollar? The Fed is the lone ranger when it comes to easing in December or maybe even in the first quarter of next year. We are seeing the 10-year yield at the 4% handle, nothing to see there. Of course, this is following on from US markets being shut for the Thanksgiving holiday. Futures also giving us a little bit of upside, but we are also continuing to track how this plays out in Asia with the so-called lack of direction for the moment, Shery.
Let's get more on the outlook for markets. And joining us now is Jasmin, Argyou, Head of Global Investment Management Australia at UBS Global Wealth Management. Really not a lot of signals when it comes to market direction in Asia today, given that the U.S. markets are closed. But we have seen that shift in narrative just across the board, right? Dovish Fed speak, a tech rebound. What will you be watching in the week ahead?
Hi, Shery. Thanks for joining us. So it's great to join you. What we're watching now and into 2026 is the outlook for global equities. And one of our high conviction views is we are very constructive on global equities in 2026. And what we are advising investors to consider is the different ways to gain exposure to equities.
Tell us a little bit about those different ways, because especially at a time when we have seen this correlation between equities and bonds moving at the same time, right?
Yeah, so that's important. So the backdrop is equities have run hard in 2026. They're up about 17% calendar year to date. And we're also at a late stage in the cycle. So some of the observations you've made is typical of late cycle dynamics. There's three possible ways that investors can consider accessing and gaining exposure to equities depending on their circumstances. So the first is for investors that are under-allocated, take advantage of pullbacks in equities. And what we've seen, Cheryl, in the last couple of months is more frequent and larger one-day corrections in the S&P 500 than we have seen any time since April, May. So that gives investors opportunities and better entry levels. All right, and the second is, to your point, the correlation between bonds and equities is now such that for cautious investors that want to access equities, it's also good to pair your equity exposure with an allocation to bonds. And for 2026, we see that bond returns for investment-grade bonds will be in the mid to high single digits. Right, and I think it's interesting to see some of the dynamics at play recently. In October, we saw a big one-day correction in the S&P 500. It fell 2.7%, and that was sparked by market concerns around tariffs between China and the US. When there is tariff concerns, markets worry about inflation, but they also worry about growth. And what we saw in October is that growth concerns outweighed inflation concerns, so bond yields fell. And so when bond yields fall, when equity markets fall, it means they're acting as a good hedge, right? So that's a good sign. And we also know that the RBA and the Federal Reserve, with policy rates either on the high end of neutral or slightly restrictive, gives the central banks plenty of ammunition to respond if economic data prints on the weak side quite swiftly to cushion economic growth, to support equity markets. In other words, the central bank put is still in play. And so pair your equity market exposure with bonds. And lastly, you don't need to gain access to equities through just one trade. We think the global outlook is good. And so a passive investment in equities can give you perhaps too much exposure to one sector or one country. We think diversified exposure will pay off.
Jasmin, you talk about how these market ructions have provided opportunity for investors to be, well, opportunistic. Talk to us about whether that picture shifts if inflation becomes a bigger problem next year, and whether central banks will have enough to act quickly enough.
That's interesting for Australia in particular, Cheryl, because the inflation numbers in Australia have printed on the high side, both the quarterly data and the monthly data. And so now there is even talk that there's two-way risk to the outlook for RBA policy. But if we just focus on Australia, what we are seeing in Australia is that the drivers of high inflation have tended to be non-discretionary items like council rates, housing, utilities. These tend to be sticky, but what might happen is consumers cannot spend less of these items, and so they might be motivated to reduce expenditure on discretionary items in order to continue spending on the higher inflation non-discretionary items. So that type of inflation can become self-limiting if it leads to moderate growth, giving the RBA the ability to just pause rather than to tighten. So I think in Australia we'll see a pause. In the US, inflation is comfortably below 3%. So what we see in the US is a reluctant Federal Reserve in terms of the easing cycle, but I don't think there's any risk that there's going to be a tightening cycle anytime soon. And we already have seen tariffs pass through, and the pass-through to inflation has been limited. So I think the risk there is definitely receding.
Jasmin, good to pick your brains on what might lie ahead in 2026. Appreciate your time and your insights today. Jasmin Argyou is Head of Global Investment Management Australia at UBS Global Wealth Management. We have more ahead on the Asia trade. This is Bloomberg.
Hong Kong firefighters say they're close to completing their search of 7 burnt-out apartment towers. This after fires are now known to have killed at least 94 people. Dozens of survivors remain in hospital, with hundreds more left homeless as a criminal investigation continues into the cause of the disaster. Our China correspondent Min Lo joins us now from an evacuation center in Hong Kong. Min, what's the latest?
Yeah, I'm actually at this market center. We are just about one street away from where the scene of the fire is. And you can see outside here on this platform is where there is a distribution center where people could get food, water, their daily necessities. And inside here, the indoor area, some of the residents have taken refuge overnight. You can see the sign, a handwritten sign that says 请安静. It means please be quiet, because obviously people are sleeping, but they're awake now. As soon as we can walk through, and you can see that there are these mattresses that people were sleeping on. You know, they didn't really have many belongings with them. And this is where they spent the night. I tried to speak to some of them, and they said that, you know, really they have no idea what they're going to do next. And if we can stop here, because there are people behind, you can see, I mean, they're just sleeping in blankets, food that they got from the social workers. Actually, one of the guys that I spoke to downstairs, one of the victims, he said that he was hoping that he would be able to go home tonight, back to his house that was burnt down. So some of them are still hoping that they can move back, but it's a really devastating situation. They're taking it day by day and still figuring out what's next. But there are 9 of these shelters that the government has set up. They will remain open until the residents no longer need them. But longer term, there are going to be 1,800 or so apartment units that the government has found that will serve as transitional housing for the residents, and that is roughly equivalent to the total housing stock of the area that was affected by the fire.
Min, as we look at this humanitarian toll, and you bringing us through one of these evacuation centers, the questions also continue swirling on where investigations are. So where are we on that?
Where exactly what? Sorry, come again?
When it comes to investigations, just a day ago, we heard how there had been arrests in relation. Yes, so where are we with that?
Yeah, the criminal investigation is ongoing, and yesterday there was a press conference, and I think residents were quite frustrated because, yes, they talk about the financial help because these families, they are each getting 10,000 Hong Kong dollars, which is about $1,300 US, and mind you, that is not a lot for someone living in Hong Kong. The cost of living is extremely high, but there wasn't enough reflection about the cause of the fire, right? I'll just take you out a little bit because it's a little bit noisy there with some of the residents. And the investigation is ongoing. A task force has been set up to investigate corruption because it seems like the authorities suspect that maybe there is some irregularities when it comes to the contracting and the oversight, because the Labour Department did visit the site as recently as last week, and they did find those substandard building materials, and yet nothing seems to have changed and led to the spread of the fire that was far more unusual than it would have been. So who should be responsible for that and held accountable? I think those questions remain unanswered. And the issue as well is that the contracting organization, it still has about, I believe, 11 or many more other construction, residential renovation projects in Hong Kong. So people are demanding answers for that as well.
Min, thank you for bringing us this reporting on what is a very heavy issue as we look to what's happening in Hong Kong for the moment. A Bloomberg China correspondent, Min Lo. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how we're trading early in the Asia session across Japan. We're seeing a little bit of downside. This after the market outperformed in the previous session. We are seeing the yen still holding and hovering around that 156 level against the US dollar. Of course, the previous session, we had the JGB curve flattening as well because of Prime Minister Takaichi's extra budget and the reports that they will be financed by additional issuance of front-end debt. So we continue to watch JGB space with the 10-year yield at that 181 level as we are also digesting the latest data. Tokyo November core CPI surprising to the upside, industrial output and retail sales also surprising to the upside. For more on the state of the Japanese economy, let's bring in Bloomberg Economics and government reporter Yoshiaki Nohara. Yoshi, so given the data today and for the past few months, this surprise to the upside and really resilience in the Japanese economy, how will that be reflected in the BOJ's policy decision come December 19th?
Right. So, Shery, as you pointed out, if you look at the bunch of economic data we saw today, it's fair to say that there is nothing wrong with the economy right now, and the inflation remains elevated. So it's a justification probably for the BOJ to stay on the track to keep raising interest rates gradually. But the question is, of course, the timing of it, and analysts are split, whether it's going to be between December or January. We don't know yet.
Yoshi, talk to us also about how much messaging do you think we'll realistically be getting from BOJ policymakers between now and the December meeting, if indeed they are corralling and shaping things up towards a hike?
Right. So, one of the things to keep in mind is that, in addition to economic data, obviously the key factor is the currency. The yen remains pretty weak, even though it has come down from dollar yen high point a little bit, strengthening a little bit, but it still remains weak, and that's going to be a sensitive topic for BOJ because you can't. They don't want to signal so much directly about the currency, but they do know that indirectly the currency has a huge impact on inflation. So that's a kind of a key area that you have to monitor, that whether it's going to be, they're going to indicate that they're concerned about higher inflation via higher import costs. Those are kind of things that, you have to think about, whether they're sending clear signals to the market.
Yoshi, how much understanding is there right now in the Takaichi administration about really the impact of all of this spending and the BOJ not hiking rates? Because investors are seemingly anxious about this enormous fiscal concern in Japan with the extra stimulus package as well.
Right. It's not a simple, there's no simple answer to answer that to that question because, number one, the inflation is actually also helping the government to rake in more tax revenue. So that's important to fund the fiscal stimulus package that we saw that it's pretty big. But at the same time, she's saying that higher cost of living is a major concern for the public. So she is saying that, Takaichi saying that she is going to do something about the inflation, but whether she wants to tame the inflation via monetary policy, we're not seeing the strong signal yet on that.
Yoshi, thank you so much for talking us through these nuances when it comes to what we consider in the path ahead for Japanese policymakers. Bloomberg Economics and Government reporter Yoshiaki Nohara. Now, of course, the path for other central banks also in focus, including the ECBs. And we got their minutes, actually, seemingly keeping the hopes for a cut alive. And that is interesting to see, given how there seemed to be this assumption that maybe the ECB was already done. There was chatter about maybe their next move might even be a hike. The minutes, I think, putting that to bed, to rest for now. We are looking flat across futures for the moment, even on euro against the greenback. For more on the outlook for Europe, let's bring in Garfield Reynolds, who leads our markets live coverage. So, Garf, talk to us about what the expectations are when it comes to Europe. There has been some Bloomberg analysis which seems to suggest that the door for rate cuts is open.
Yeah, well, nobody really thought that the ECB was necessarily putting the rate cut tool on the shelf, but they did think that they were at least putting it down on the table, so to speak, mixing my metaphors a bit. There's not too much that's signaling that Europe would need further rate cuts. And in a lot of ways, what's really mattered, what's helped support the euro this week, is what's been going on with the Fed, where it's very clear the Fed is expected to cut in December. And although markets haven't moved to significantly shift the pricing for what's to come next year, the main risk for the Fed is that it goes further than expected rather than less, given that President Trump will be moving to name somebody else with Chairman Powell's term ending. So the Fed being far more likely to cut than the ECB, that supports the euro, and equities will probably welcome the idea that the ECB still will retain the potential to cut, though another major concern for assets across Europe is just how the Ukraine situation is going to work out. We've got this very confusing situation where we may or may not be moving closer to some sort of resolution for the Russia-Ukraine situation. In particular, while Russia and the US seem to be sounding hopeful that some sort of a peace might be feasible, Europe is deeply concerned that any peace that is acceptable to Russia in particular is not going to be one that is going to create good outcomes for Europe. So that hangs over European assets a bit, especially heading towards that end of year period where the economic and policy side of things starts to drop away as a driver, and geopolitics gets to play a bit more of a role.
All of those factors really will drive the U.S. dollar as well, right? Overnight session pretty thin. Of course, the U.S. markets are away on holidays, but we also saw some month-end buying to support the greenback. So where are we headed into 2026 now?
Well, 2026 is looking like potentially a very tough time for the US dollar, especially if the Fed does cut next month, which is a strong expectation. And of course, we'll get the dot plots. We'll get the potential that they will signal greater openness to cuts next year. So far, the pricing for next year, as I said, has been pretty stable. But the policy signals are such that the Fed is seen being willing to err on the side of cutting sooner rather than later. That sets up a poor dollar outlook. I was looking yesterday at the relative yield setup. 2-year US yields are back to the sort of levels, the sort of narrowness relative to peers that helped to set off what happened in the first half of last year when the US dollar came crashing down. So the US dollar enters 2026 in danger of tipping into a fresh sell-off.
Garfield Reynolds, who leads our MLive Asia coverage. Always good to have you with us. The top corporate stories that we're tracking as well. Taiwanese prosecutors have searched the homes of a former TSMC executive suspected of leaking trade secrets to his new employer, Intel. It signals an escalation in the government's criminal investigation into the high-profile dispute. TSMC has sued Lo Wei-jin, alleging a high likelihood that he shared sensitive information with Intel, something the U.S. company denies. Alibaba has made a rare foray into hardware, releasing smart glasses powered by its Qwen AI models. The product, called Quark S1, features built-in translucent displays that superimpose contextual information on the user's view of their surroundings. The glasses are equipped with cameras, bone conduction microphones, and swappables. And coming up, we explore the circular deals shaping the AI world and how Asian firms are seizing opportunities and facing new risks. Bloomberg Tech Asia is next.